Hello everyone, welcome to today's webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today our webinar title is How to Apply Technical Indicators Effectively. My name is Shen Chu, I'm the moderator for this session. So welcome to this session everyone. Now as you know, there are a variety of technical indicators in the market. Okay, there are easily thousands of technical indicators. So of course, there are popular ones such as RSI, Stochastic, MACD, and different indicators are designed to serve a different function. Some are used to confirm trends, some are used to do forecasting, some are used to confirm, to tell us the strength of a trend and so on, or any change in the momentum. So different indicators are designed differently, and how do we apply them effectively? So that's the session all about today. So if we can know how to utilize all these different tools and indicators effectively in trading, we can improve our trading edge. We can probably increase our winning probability and also increase our win to reward ratio. That would help us to improve our trading edge in the market. So today we're going to look into this topic deeper. All right. So disclaimer, whatever I share in this webinar is only for educational purpose. So in no way that will give you any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you're responsible for all your investment risks. Allow me to briefly introduce our speaker today. Our speaker today is a licensed and experienced financial planner who is certified by the Malaysian Securities Commission Financial Planner Representative License and also Bank Negara Financial Advisor Representative License (FAR). She's also a course trainer and public speaker at Financial Planning Association Malaysia and also Bursa Malaysia. And currently, she is the chairman of the FPAM for the Johor chapter. So over 25 years in education, she has accumulated over 50,000 students and conducted over 200 large-scale corporate courses. So other than being a professional financial planner and educator, she's also a best-selling author who has published 6 books on investment and financial planning. So her articles have appeared in financial magazines such as The Personal Money, Money Compass, and many more. So she's none other than Pauline. So welcome, Pauline, to this webinar.
Hi, thank you, Shane. Hi, good evening, everyone. It's good to be back again to conduct this Bursa webinar. So today I'm really happy that I'm talking about these technical indicators, because a lot of people they told me that how come I find that the indicator is not consistent. Okay, so which is why I think today's session, it is very important, because it's not that the indicator is not effective, it is how you use it, because it depends on how you use it. Different chart, you will have to apply the indicators differently, because there will be certain indicators that is suitable for a trending chart, and certain indicators is more suitable for a horizontal trend. So you must be able to identify that before you can apply it. Okay, so let's share the screen here.
Yeah. And I think, Pauline, you're also a certified financial technician, right?
Yeah.
All right.
I'm a licensed financial planner and also a certified chartist.
Yeah, so one of the few female chartists.
Yeah.
So over to you.
Okay, thank you. Thank you, Shane. So here, this is the agenda for today. We are going to look at the different types. There are so many different indicators. We are not going to look at all of those. I just look at the popular technical indicators, the basic ones that most people would use. Okay, so then after that, I will look at the pros and cons of each of the indicators, because we need to understand the theory behind these indicators so that we are able to utilize them effectively. Okay, so we need to understand the strength and the weaknesses of the indicators so that we can apply more effectively. Okay, then and to demonstrate how we can use the different types of the technical indicators. Okay, as we go along, feel free to ask me questions, type in the chat, And then as I see the questions, then I will answer your question. Okay, so let's proceed. Okay, so the very first indicators that I want to introduce to you is moving average. Okay, and what is a moving average? So let me share my screen. You will see that a moving average is something like a line like this. Okay, so it will be now in this case I have two moving averages here. Let me cross out some extra moving averages. Okay, so here I have these two moving averages. So where do you get the indicator? So here I have tradingview.com. Okay, because this tradingview.com is a free online charts, and they have, you can use up to three technical indicators. So if let's say you want to use more than that, you need to subscribe. Okay, so you click this, you click the indicator here, and then you can type MA. Okay, MA stands for moving average, and then you click. Okay, then it will come up like that. Okay, so the default moving average is a 9. Okay, so you can click here, you can see that there is a setting here. So you just click the setting and you change the 9 to whatever you want. Okay, so in this case, my favorite is 20 and 200. Okay, so I just type 20 and then I change the color to red color, and that's it. Okay, so this red color will be my 20-day moving average. And there's a green one. So this green one will be the 200-day moving average. Okay, so then you see that this moving average, right, is actually moving around the price. So this green and red color, these are candlestick, and these are the price chart. Okay, so let me explain further what is a moving average by using the Excel worksheet. Okay, you need to know how do you derive the moving average. So here is the Excel worksheet. And let's say we have a Maybank share. Okay, let's say the Maybank share is, we are looking at 10 days. Okay, so I have 10 days here. And let's say the price is, I just simply type the price. Okay. Simply type the price and just like this. Okay, just say this is the price. Okay, every day it's different pricing. Okay, so this is the price, and then based on the price, I'm going to calculate the moving average of the price. So let's say I have a 3-day MA line. Okay, 3-day moving average. So 3-day means what? Means that for the past 3 days, what is the average price? Okay, so this is a simple moving average. So for the past 3 days, what is the average? So it's equal to sum bracket and then highlight this, close bracket, divided by 3. Okay, so that's how you got the 3-day moving average for the past 3 days. How about the next one? So for the next one, it will be this, and this, 3 days, the past 3 days. And the next one will be this, and this, the past 3 days. So I just need to drag this down. Okay, so this will be my moving average line. Okay, so this will be my moving average line for this price. Okay, so let's say I want to do a 5-day. So then 5-day MA line. So how do I do that? It will be 1, 2, 3, 4, 5. Okay, over here is equal to sum 5 divided by 5. Okay, and I drag it down, and this will be my 5-day moving average. So now I want to plot the line. I can insert the graph using this. And this is my chart. So the blue line will be my price. And the orange line is my 3-day moving average, and the gray line will be my 5-day moving average. So from here, you can see how I derive the moving average lines. Okay, so you see that the moving average line can't see the screen. Can't see the screen. Can other people see? Yeah, other people can see, right? My another device also can see. So maybe you can log out and then log in again. Okay, so can, okay, thanks. So here we are trying to derive the chart by a raw data. So I key in all this raw data, and then I do my own calculation, and then I derive my chart. So in the tradingview.com, right, you do not need to key in your own thing. Okay, so they have everything inside the software, so you can actually see the chart by itself. So, but you need to understand how you derive. It is based on the average. Okay, and a lot of people, they also compare the simple moving average and the exponential moving average. Now, what's the difference? Okay, so the exponential moving average, this is a formula. I will never remember the formula because it is a bit complicated. Okay, so there is a multiplier here, and the function of this exponential moving average is that the calculation is that they will put more weight. Okay, that they will put more weight to the recent price. So for example, you have a 10-day moving average. Okay, so 10-day moving average, if you to compare just now the simple moving average, we just use the past 10 days, and then we divide it by 10. Okay, so just now it was a very simple, just average. So just day 1 until day 10, and then we just average out and then divide it by 10. But however, for this exponential moving average, right, there is a multiplier, is a k multiplier, which is 2 divided by n plus 1. So meaning that if my n is 10, okay, if my n is 10, then my multiplier will be smaller because my n is 10. Then 2 divided by a big number, then this multiplier will be smaller. So if let's say my n is 1, then my multiplier will be bigger. So in fact, if you look at that, that means I'm trying to put more weight to the recent price. So the recent price will be the day 1, okay, the most recent one. And then by the time when it go to the 10 days, the 10 days ago price, it will be long time ago, 10 days ago. So then this 10 days ago, my multiplier will be much smaller. Okay, so meaning that those far further away days, the multiplier will be smaller, and then it will affect the price smaller. So then you will see that the exponential moving average, right, will have to put more weights to the recent days, okay, in terms of their price. So if you were to look at the chart here, let's say we change this to exponential, okay, and put one more indicator, and this indicator is exponential. Okay, so this one is EMA, and then I changed the color to, let's say, purple color. Okay, purple color, and then the number here I put 20. I want to compare 20 SMA and 20 EMA, and then I want to see what's the difference. Okay, so do you see that the purple color is closer to the line? Okay, due to the price. Okay, the purple color, this one, the EMA, is actually closer to this price. So meaning that if you are looking at the difference between the exponential moving average and the simple moving average, the exponential is actually closer to the price. So then when do you use exponential moving average, and then when do you use the simple moving average? Usually for me, I will use the EMA to the technology stocks and those fast moving stocks. because they are like moving up and down. It's like trending and then fast moving. So then I will use EMA is better. Whereas a simple moving average, I will generally apply onto index, commodities, blue chip stocks. Okay, and then you will see that the effect is better. Okay, so that's why you need to know the nature. Somebody asked me under what situation, right? Okay, so then you will see that when you are looking at those technology stock or US stock, then you use that exponential moving average. And then if you are looking at index and blue chip stocks, then you use a simple moving average. Okay, so for me, I like to look at the because the difference is just a little bit. So I will be standardized and then I'll use simple moving average. Okay, so I just cross out this one. Okay, so then next. So if you have any question, feel free to type in the chat. Okay, so Sazal. Okay, Sazal, you say you can see now. Okay. Oh no, that's MY. Okay, MY say that you can see now. That's very good. Okay, so as long as you can see clearly, that's great. So then this is the moving average. Okay, so let's take a look at the different types of the moving average. So for the moving average, we have 10 days. The common ones will be 10 days, 20 days, 50 days, 200 days, 100 days moving average. Okay, so the different days. So the bigger the number, the longer term it is. Okay, because you are looking at 200 days means the past 200 data, which is the average of the past 200 data, which is a long-term analysis. Okay, so usually for short-term analysis, we will look at the 20-day and the 10-day. For medium term, we will look at the 50-day and the 100 days. And for long term, we will use the 200-day moving average. Okay, so then how do we use it? So for those of you who are new, okay, you probably will find that all these technical indicator is a bit overwhelmed because wow, I have this moving average, I have RSI, stochastic, so many. Then how to look at it? Okay, so if you are looking at that so many indicator, we go one by one. Okay, we go for the easiest one, the most common one, which is the moving average. And you can see that the moving average, when the price is above the line, okay, so this is a 20-day moving average. So when the price is above the line, you buy. Okay, so when it cross down, you sell. Cross up, buy. Cross down, you sell. So then this give you a signal to buy and sell. And that 20-day is for short term, and that 200 days is for long term. So however, I have to say that you cannot just use the moving average alone without the trend line. You must use together with the trend line. Okay, so you see this is like moving zigzag, zigzag, right? So let's say you are doing some short-term trading. So short-term trading meaning that you want to plan to hold for like either 1 month to 3 months kind of a holding period. Okay, so you do not want to hold for more than a year, so more like a 1 month to 3 months. Okay, so it's more like a short-term to medium-term kind of a trade. So then 20-day moving average will be a good index or a good indicator for you to try. Okay, let's say we are looking at this 20-day. Okay. So now the next thing I want to teach you how to draw the trend line, because we need to use it together with the trend line. So I'm going to click the trend line here. You click here and then you got the trend line. So you see these red lines, right? So as long as the red lines are moving like this, okay, so we can connect like this. And the 20-day moving average line is like a guide for you to draw your trend line. So you can cross your trend line together with the moving average line. So the effect will be better. Okay, so if you see that I'm drawing this trend line, Whereas the 20-day moving average, right, over here, merge together with my yellow line, and then the price cross down. Okay, so that means that when the price go down, it crossed these two lines together. It crossed the 20-day as well as the 45-degree line. Okay, it crossed these two lines. So when it crosses these two lines, right, that means that this short-term trend, uptrend is over. Okay, so you have to sell. So when do you buy? You buy here. Okay, you buy here when the 20-day moving average cross above it. And also when you draw a trend line, it also cross above it as well. Okay. Okay, so you see that it cross. So cross both, and then you buy. And then you sell here. And when you see that the line is moving horizontally, okay, so when you see the line is moving horizontally, you notice that the moving average line doesn't work so well. Okay, so therefore, I'm going to tell you the weakness of the moving average here. So the weakness of the moving average is when it is moving horizontally like this, the trend, okay, the trend is horizontal, moving average is the least effective. It's not effective when you are moving horizontally. Okay, so then when is the moving average effective? Is when you are trending, uptrend, downtrend, uptrend, downtrend. Okay, when you are trending, it is effective. And when you are horizontal, not effective. So if you were to just to use that line and then to tell you when to buy, when to sell, you're going to lose money here. You will lose money. Okay, because it will have a lot of false signals. Okay. Zoom in. Okay, sure. So I'll zoom in. Better. Okay. So here you see it is moving like a sideline, right? Horizontal trend, and it is like crisscross, crisscross. So if you buy, sell, you lose money here. So then when it is horizontal trend, you draw a trend line, okay, to show that it is horizontal trend, and then waiting for a breakout. Okay, so that's why you need to use together with the trend line. So here it break out. Okay, it break out, then you buy here. After it buy here, then you wait for the trend to be over. Okay, so you draw a trend line as well. Okay, so you draw a trend line, and you see that the price break below both of these, the red line together with the yellow line, sell. And then after you sell, when do you buy? Here, you buy here. Okay, so that it cross both of these lines. The red line and the yellow line cross up, buy. Okay, so you know how to draw a trend line. It is important to learn how to draw the trend line, because otherwise if you draw it differently, then you may not be able to generate that kind of a buy and sell signal. Okay, so then here we are looking at this trend whereby sell here. Okay, here we are looking at another trend that waiting for a breakout. Okay, so waiting for a breakout over here. Okay, if I were to change to white, right, then it will be a bit glaring. Okay, so if you see, you change, if I change to white, do you find it a bit glaring? Is it better if I change to white? Prefer black, right? So yeah, I find this very glaring. Prefer black. Yeah, that's right. So that means if you look at this front can, this technology stock, the front can, you see that moving average work quite well, okay, with this stock. Okay, it worked quite well. And you'll be surprised, okay, not all the stocks can work so well with the moving average. So you need to do some back testing. Back testing meaning that you have to look at the previous trend, and then you try to use this indicator together with the trend line and see whether it works or not. So if it works, then it suits this chart. Okay, so that means what? That means you cannot simply say, okay, this is ABC chart. All the chart I will use moving average and then apply to every chart. No. In each of the stock, right, you need to understand the behavior. So because I know that this technology stock is more fast moving one, so that's why I apply the moving average. So if let's say I show you a slow moving stock, okay, let's say Maybank, okay, Maybank is a slower one, and it is like moving horizontally for quite some time. Okay, so this is Maybank. You see that the moving average line, right? It is actually the 20-day, right? It is actually across the body of that candlestick. It is like not really as good as the front can. Okay, it is like crossing the body of that candlesticks. So meaning that you have a lot of false signal here. So definitely, but however, if you're to use together with the trend line, you can still use it pretty well. Okay, so that's why you have to use together with the trend line so that you can avoid all the false signals. Okay, so you see I use together with the trend line and it still works. Okay, and especially if let's say if you're looking at horizontal trend, okay, you see that it is like crossing. Okay, so not so effective. So that's why you need to use the trend line. Okay, do we need to what now? Okay, wait now. Do we need to, I can't see that word, stick one particular MA, or we should vary? So for example, Tanaga is also another slow stop. Okay. This one is also crossing. So when you see the line is crossing inside the candlestick, so that means that it is not really enveloping. Just now the front can, you see the red line is actually outside the line, touching the top of it. Okay, but this one you see that it is like merging together with the price. So therefore, if you see something like that, right, you can edit your moving average here. You can change to maybe 30 or 40 and then see whether it can look better. Okay, so if I change to 30 or 40, it can go outside of that, and then it's like touching the outside. Okay, so that means that you can actually change the moving average such that it will suit this chart. Okay, because this chart, the nature is more like a slow. Okay, so then you have to use a bigger moving average to suit this, so that you see that the lines are enveloping pretty well. Okay, then you will have less of those false signal. So that means that you can change the moving average line according to the chart. You have to know what is the nature. Okay, let's say another one, Nestle. Okay, Nestle is a very horizontal trend. Okay, you see that this one is a very horizontal trend. Even when I have 40, right, the line is completely inside the price here, completely inside. So that means 40 also no use. I have to use maybe 80 or something so that it will be going to envelope nicely outside the chart. You get what I mean? So the slower the stock, right, the bigger will be the moving average in order to envelope well, wrap around well the price. Okay, but nevertheless, even if you to use 20, it's not that you cannot use 20. You can still use 20, but the important is that you still have to use together with the trend line. Okay, then you will be sure that when is the exact breakup, so that you do not have all those false signal. Okay, time frame. Okay, so actually, I do change a little bit. If let's say I have a 15-minute time frame, I will change to 8 days. Okay, and 20 days, 28 and 20. Okay, so I do change a little bit. So if let's say you are looking at a 15-minute chart, okay, this is a 15-minute chart. So I will change the moving average here maybe to 8, and then another one to 20. Okay. And then I will zoom in and then so that I can see better. Okay, so I can do like that too. Okay, so that means I have to play around. Okay, play around with the figures and then try to see what numbers are more suitable for that chart. Okay, so then you can see that, oh, this number is good for this chart. Okay, so usually I will not, I apply this to the index, to the KRSI index. The 8 and the 20 is for the KRSI index. Okay. Okay. How do we know the time frame is suitable for the stock? Okay. The time frame is when you want to ask yourself, am I for the day trade or am I for the long-term trade? Am I for the medium-term trade? You ask yourself, are you going for this for the day trade? Or are you going for a weekly trade or monthly trade? What is your time frame? You ask yourself, okay? So if let's say I'm going to go for a weekly trade or a monthly trade, so I'm going to hold for a few weeks. So if your answer is like that, then you have to look for a daily chart. Okay, so if let's say, okay, I'm going to go for a day trade. So within the day, I must close my position. So if it's a day trading, of course, you use a 15-minute chart, 5-minute chart, 1-hour chart, 4-hourly chart, and then you go and see the back and forth when it is having a different time frame. How does the chart develop? Okay, so that means the time frame of the chart depending on your own trading time frame. You got it? Okay, so this whether 15-minute, daily, or whatever, right, depends on what you want to trade. Do you want to trade for short term? Do you want to trade for medium term? Or do you want to trade for long term? Okay, so if let's say you just say, oh, I'm going to just be a long-term investor. So if you're a long-term investor, don't bother to look at that 15-minute chart. Don't bother, you go for that weekly chart. If you are a long-term investor, you go for that weekly chart or at least daily chart lah. Then you see what is that trend. Okay. Does the moving average numbers reflect the volatility of the stock? No. The numbers is just looking at what do you want. Okay, again, come back to you. Do I want to have a short-term view or long-term view or medium-term view? If I want to have a short-term view, I will choose a 10-day or 20-day or 8 days. Okay, so that moving average number is depending on your own time horizon. What is the time horizon that you are looking at? Okay. So when to use the monthly chart? Okay, I will use the monthly chart for long-term analysis. So for example, I usually look at the monthly chart for index. Okay, let's say KLCI index. Okay. So KLCI index, I will use the weekly chart and I can also use the monthly chart. And then for this trading view, right, you can see up to 1980 figure, okay, up to 1980. So you are looking at 30-year chart. So this is up to 1982. And then here, so you are looking at long-term chart, 30 kind of a 30 years chart. So then you can use a monthly chart and then you can see everything in one. If you to click that daily chart, you won't be able to see everything. Okay, so that's why the monthly chart is for you to analyze long-term trend. When do I use the weekly chart? I will use the weekly chart for like a long-term analysis and also even for the medium-term or short-term analysis, because I need to see what is the overall view. Then I will look at from that monthly to weekly to daily. I will interchange it. Even for a daily trading, right? I will just have to keep on changing, okay, from monthly, daily, weekly, and then 4-hourly. I just have to see what is the overall view. Okay, so it's not like there is a fixed rule. There's no fixed rule in technical analysis because look at the situation, then you have to apply things differently. So it's very hard to say fixed that you must do this, must do that. No, because technical analysis is an art. Okay, it is a science, but it is also an art. Okay. Okay, so Okay. Right. Of course. Of course, when we are analyzing, right, we need to look at both fundamental and technical. That is my usual practice. I usually will look at both fundamental and technical together. Then only it will make sense to me. But however, I do know quite a number of people that they do not look at the fundamental. They just purely look at the chart and they just trade on the chart because they think that the fundamental are noise. Okay, so if you are really focusing on the trading, you do not want to listen to too much noise, and then you may want to ignore the fundamental when you are doing some trading. Okay, so it's personal preference, it's personal, it's up to you. Okay, so for me, I just look at both. Okay. Okay, crossover. So some people, they like to use the moving average 2 lines. That means they'll use a 10-day and a 20-day, a 20-day and a 50-day moving average line. And then when they cross over, it will tell you the buy and the sell. Okay, say, for example, you want a buy signal is when the 10-day cross above that 20-day line. So it's a buy. So, and this is one example whereby the red line is a 20-day and the orange line is a 50-day. So crossover, this combination, 20 and 50, right? The crossover, we call it a golden cross. Okay, so there's a term for it. It's called the golden cross. And when the 20-day cross below it, we call it the death cross. Death. Okay, the name is scary. This one is a death cross. So this one is a golden cross. Okay, a golden cross meaning that the 20-day cross above that 50-day, that is a buy, so it's called the golden cross. And this is for medium term trade or investment, medium term. Okay, it's medium term investment. So this is called the death cross, and this is the golden cross. Okay. How do we decide? Good question, Shazila. Okay, Shazila, how do we decide when do we use 10-day, 20-day combination and then 20-day, 50-day combination? Okay, see, I'm using the word medium term here. So you can guess 20-day, 50-day is for medium term kind of investment. Okay, so, and then the 10-day, 20-day is for shorter term investment. Okay. Is there a way to determine when is the lowest price to buy? Okay. Ahmad, very good question. We are going to come to that indicator. It's called the RSI and the stochastic. Okay, so we're going to come to that. It's another indicator. So this one, when it is crossover, right, it will never be the lowest. Whenever you have a crossover, right, always remember, it's not the lowest. It is usually the breakout. Okay, the breakout point. If you want to aim for the lowest, right, it's not this indicator already. It's not moving average. Okay, it will be another moving average. Okay, so that's why you need to know what you want first. Okay, so I must say that, okay, I want to buy at the lowest price. So then, okay, lowest price, then we cannot use this one. We have to use another indicator. Okay. So this one still on the moving average. Okay, so let me just cover this little part here. So moving average, there are some rules here. So there is a 3% confirmation rule. So because whenever this is the price, right? And then you have this 20-day moving average line that cross over. So then cross over this line. So then there is a rule of a 3% confirmation that when it cross above 3%. So let's say it crossed here, which is let's say it's the main bank lah. Okay, 850. Okay, 850, it cross over. So you have to use a calculator. 850 times 3%, 25 cents. Okay, so you have to add 25 cents become 875. When it go up to 875, then it is successfully breakout. Okay, so when it go up by 3%, successfully breakout. So that is one type of confirmation. Another type of confirmation, you can wait for it to break out and then wait for it to retrace. Because after it break out, right, it will not go all the way up to the roof, right? It will retrace a little bit. So when the moment it retrace, right, it's a confirmation as well. So the price will break out and then will retrace and then go up again. So this also a confirmation. This will be maybe a few days or 1 week later, 1 or 2 weeks later, then you see this confirmation. Okay. And there's also other types of confirmation. For example, some people, they, after the breakout, right, they will count the candles. Maybe the second candlestick or the third candlestick, then only they confirm, then only they go in. Okay, so there are different rules. So this is one 3% rule, and then the retracement rule is another one, and another one is the candlestick. You count the candlestick. And definitely you have to draw a trend line. And also the longer the time span of the MA line. So this, somebody asked a question just now, right? So when you are looking at the longer time frame, like 200-day compared to that 20-day, that 200-day moving average is more important, more significant. So if let's say, okay, I'll show you back to Franken again. Okay, so that's daily chart. Okay, say for example, this one I changed back to 200. This one I changed to 20. Okay, say for example, this front canner, you see, I can cross up above and below that 20-day moving average for many times. But my 200-day moving average, I didn't cross below until here. Okay, so which means what? Which means that when you are crossing up and above that 20-day moving average, right, your trend is still pretty much uptrend. Okay, it's still pretty much uptrend. But the minute you cross that 200-day moving average, right, do you see that the trend is facing down already? It's downtrend now. Do you notice that? Okay, when it is above that 200-day moving average, right, you are very comfortable. You are swimming on the sea, and then you are like bouncing off from that 200-day line, and then you are on a bullish trend. But the minute you cross over and then there is a retracement cannot break it, and then you confirm this confirmation, it is a downtrend. Okay, so this downtrend, you draw a trend line, still not able to break out yet. Okay, so which is very important. The 200-day is more significant than that 20-day. It will give you a bigger signal that the long-term trend is over. Okay. The direction of the MA line, because the MA line also will go up and down, right? So the direction when it is facing down, it's bearish. When it is facing up, it's bullish. Okay. Okay, next, we look at that MACD. Now for MACD, right, it is two lines. You looking at that 26-day and the 12-day EMA. Okay. Yes, the slope of the MA will tell us. So if let's say you see the MA line is like moving horizontally, drifting. So the market is lack of momentum. So if let's say the slope of that moving is like steep or down or up, that is full of momentum. Okay, so the slope is also tell you about the momentum of that MA line. Okay, good. Okay, so next we look at this MACD. So MACD is made of this 20-day and that 12 days EMA, exponential moving average line. Okay, so this blue color line is the MACD line, whereby you use the 12-day EMA minus the 26-day EMA, and then you derive that figure here. Okay, so you derive that blue line here, which is the MACD line, And then you are trying to generate a signal line by using a 9-day simple moving average, 9-day moving average line on that MACD line. So then you draw another line, okay, which is 9-day of this line. So you have these two lines. One is the MACD line. The other one is what we call a 9-day moving average line of that MACD line. Okay, so then how do we use it? There are three things that we can use from here. Number one, the zero line, this is the center line, okay? So when you look at the MACD line, the blue color line, above the zero line, it is uptrend, okay? So MACD line greater than that zero line, bullish. So if it's below, then the zero line, bearish. Okay, number two, buy and sell signal, when to buy and when to sell. So when the blue line, MACD line, cross above the signal line, buy. Okay, MACD cross above the signal line, the red line now. Okay, then buy. Okay, then number three, overbought or oversold. So this one tell you the momentum. How do you see the momentum? Looking at the histogram. Okay, histogram, whereby you see the histogram here, the tall ones are, whenever you have tall histogram, there is a momentum there. Okay, so here you also have a tall histogram here. So momentum is very steep here. Okay, and when you have a down here, it means that there's some sell down here, sell down. Okay, so this histogram tell you the momentum. So in summary, MACD gives you three information. Number one, bullish or bearish by looking at that above the zero line or below. Number two, buy or sell by looking at that crossover line. And number three, the momentum by looking at the histogram. So for example, if you see that this one has crossover, but it is still below that zero line, so that means you are still in bearish mode, although this has given you some signal to buy, but you are still in the bearish mode. So you can tell yourself, okay, let's wait for the MACD line to go above it. So finally, when it go above it, then only you buy, but it will not be the lowest point now. It will be, you know, on the way up already. Okay, so MACD, like the MA line, because this MA is from this moving average. Okay, so we are looking at moving average. So in fact, MACD is another form of a moving average line. Okay, so can you tell me if I have a chart like Nestle? Okay, if I have a chart like Nestle, okay, a chart like Nestle, is it effective to use MACD? Is it effective to use MACD if I have this chart? What do you think? Will it be effective? Yes or no? Why not? Why not? Okay, yeah, why not? Sideways, yeah, correct. Because it is a sideways chart. So when you use the MA lines, any form of a MA lines, it won't be so effective because it will be crisscrossing. Okay, there will be a lot of false signal. Okay, so you need to understand the chart itself first, whether this chart is a trending chart or a horizontal chart or whatever. Then you will know that what indicators to use. Okay, no trend. Okay, good. Okay, then quickly. So in more details, okay, to give you a more details explanation, you see, how does this lines is formed? First, the black line is when you use the 12 days minus the 26 days exponential, right? So that's how you form that black line. Then how you form the red line is the 9 days moving average of the black lines, okay? Then how you form the histogram. So the histogram is when your black line and the red line here, the distance. You see, when you have big gap here, the histogram is the tallest. So when the MACD line cross with that signal line, this one, the cross here, the histogram is 0. Okay, you see when it is cross, right? It is 0 here, 0, cross, 0. And the gap is highest here, this histogram is the tallest. Okay, you see this gap is also big, and then histogram is also very big. So meaning that whenever you have big gap, it means that momentum, the stock is having some momentum trade, okay, or trend. But before it forms sideways, how do we know? Good question. Before it forms sideways, you will never know until maybe a week or so. Then you see that, okay, it is like moving horizontally. Okay, so it will take some time. Then you will see that, okay, it is forming a sideways. Yeah. And you can tell from the direction of the moving average line as well. So if your moving average line is also like moving on a horizontal instead of, trending, then you know that basically it is also horizontal trend. Okay. So this is a buy and sell signal. Okay, next, stochastic and RSI. So for this stochastic and RSI, I want to use these two together because these two are very similar. Okay. Normally, how long does the stock move sideways? Good question. I'm going to show you. It depends on the stock. Okay. It depends on the stock. So you see, I show you a weekly chart lah. So you look at this one. Okay. You see, this one is our KLCI index. Do you see that for a long time we are moving sideways? So it's really hard to say when do we know it is moving sideways. It's really hard to say. But some stock can be horizontal forever, and some stock can be trending. So it depends on the fundamental, depends on the demand and supply, depends on the buying and selling of that particular stock. So it's really, there is no answer to it. We do not know how long it will go sideways. We really do not know. Okay, it's based on the fundamental, it's based on the demand and supply and everything. Okay. Please don't use the chart only if not accurate and subject to high margin of errors. Yeah. So if you want to use to combine it with fundamental, yeah, Team Chan, yeah, okay. So definitely we have to combine the fundamental and technical together, right? Very good. And what period would you use for EMA if you are doing a day trade, term trade using a 5-minute chart? So Chan, Chugan, you are looking at what stock? What stock are you referring to? Because it will mean differently. If you are asking me index, KLCI index, then I will use a moving average. I don't use a EMA. I just use a moving average, 8 and 20. So it depends on what stock you are using. Okay, you are looking at. So it really depends on the behavior of the stock itself. Then only you can say, okay, this behavior of the stock, I'm going to use this EMA or moving average or whatever. Okay. Okay. Very good. So let's continue. Is there delay in the trade view? Yeah, free one, of course, delay, right? 10 to 15 minutes delay. Okay, 10 to 15 minutes delay. Okay, so which means that if you are going for intraday trade, you can't rely on this one because there's a delay. Okay, unless your trade is more on a swing trade. Okay, swing trade, so doesn't matter. Okay. You did mention sideways moving average can't use, but before it form MA, when are we going to change the other indicators? Okay. Okay, so Eunice, you are saying that when it is sideways, we can't use it, right? So sometimes we need to draw the trend line. Okay, so when we draw the trend line, then we know that whether it is sideways or trending or not trending. So so that means that if let's say you draw the trend line, and then you notice that how come the trend line is horizontal, then you know that in this situation you will have to use a moving, you can't use a moving average, and then you have to use RSI or oscillator kind of indicators. Okay, so you have to draw the trend line, then only you will know. Okay, how do we find the behavior of the stock? Jane, the behavior of the stock is by your observation and your study. Okay, so if let's say you throw one stock to me, ABC stock, and I have never studied this stock before, and then you ask me to trade that stock, I can tell you I can't trade successfully on that stock because I don't understand this ABC stock. Okay, however, if let's say you throw one index to me, okay, you say S&P 500 index and ask me to trade, maybe I can trade okay for this S&P 500 index because I've been following the S&P 500 index for more than 10 years, and then every week I look at the chart for on a weekly basis. You get me? So that means I know the behavior of the chart is because I have been following this particular index or stock for many years, and I know how it behaves. Okay, so that is why the behavior of the stock depends on how much you follow the chart. Okay, what is your experience to that chart? Okay, what do you base on when decide which day to use, like 5 days? Okay, so I will look at that, the behavior of the chart. So if it's a fast moving, like a technology, so maybe I will use I still use a 20-day, but I will use a EMA, exponential moving average, on a technology stock. And if let's say I am looking at okay, so in order to answer Wee Han's question, right? What your question is actually, another person actually asked the same question. Okay, so actually when we're using 5 days or 10 days or 20 days, right, depends on our time frame, whether you want to trade for short term or medium term or long term. So 5 days is a very short term trade. Okay. The behavior of the stock as referred to the indicators? No, the behavior of the stock as referred to the price behavior, not the indicator behavior, but the price behavior. Then only you decide what kind of indicators to use on that stock. Okay. Okay. So okay, keep posting. Yeah, when you have questions, keep posting while I move on to the stochastic and the RSI. So stochastic and RSI, I will use it together because they are the momentum. Okay, so before, just explain the formula. So the formula is for stochastic, you are looking at default 14 days, the past 14 days, the current close minus the lowest close for that past 14 days, which are the lowest for the past 14 days, which is the lowest, you minus that lowest, divided by the past 14 days, right? The highest minus the lowest. Okay, so you got this percentage K line. Then percentage D line is the 3-day simple moving average of that percentage K line. Okay, so now you understand pretty well how this line is being, you can, when you understand this, right, you can even invent your own indicators. So that is why you see there are hundreds, I do not know whether it reached 1,000 of indicators, because people who study, they know all these indicators, right, the formulas and everything, right, then they can invent their own indicators, and then you can name it after your own name. Okay, you say Pauline's indicator, you design your own formula, and then you can use it. So you can actually use it, play around with the formula, and then you try to devise it. Okay, so here we are looking at this looking at the momentum. Okay, the past 14 days, the highest, the lowest, and then you try to see the momentum. Okay, where the current price as compared to that volatility. Then so this is the stochastic, and the stochastic has 20%. This is a scale. Okay, the scale is from 0 to 100%. So this is 20. This line is 20%, and the upper line is 80%. So whenever the stochastic fall below that 20%, we call it oversold. Okay, oversold when it is below 20. So when it is above that 80, right, we call it the overbought. So just now, somebody said, I want to buy at the lowest point. Okay, there you are. The oversold will give you the lowest point. At this moment, it is the lowest point, and then it goes back up. Okay, so whether forever this is the lowest point, we cannot guarantee that. Why? Because if you are in a downtrend stock, the RSI keep hitting the oversold. Okay, as you are moving down, right, the RSI keep hitting the oversold. So when the minute you buy here, you are the lowest within that area. You are the lowest. But however, when the trend continue to go down, right, the next time when it go down, right, to this oversold, right, you probably at another lowest point here. So meaning that when you are in a downtrend, okay, and you are using the stochastic or RSI, you will probably be ended up buying lower and lower and lower and lower. Okay, so that is the thing about using stochastic and RSI in a downtrend. So meaning if it is in a downtrend and you know that it is going down, okay, you draw the trend line, you know that it is in a downtrend, and then you know that if you to use RSI, you have to be prepared that you may not get the lowest price. Okay. However, then when do you use it? If it's a horizontal trend, okay, or if it's a uptrend. So if it's a horizontal trend or an uptrend, you are buying in dip. Okay, you touch the 30, 20, then it's low, you buy. So you are buying in dip. Okay, so when you're in the uptrend, that means you are going up, but then whenever there is a oversold, you buy. Whenever there's an oversold, you buy. So you are nicely moving on an uptrend, but then every time when there's an oversold, you buy. Okay, oversold, you buy. So it works well if you're on the uptrend. Okay, you won't feel so bad. At least you are buying on the way up. Okay, not like in a downtrend, you are buying on the way down. You get what I mean? So now you know the trend first. Okay, the trend, is it a horizontal trend or is it a uptrend or downtrend? And how do you know the trend? You draw the trend line. Okay, you draw the trend line. Oh, this is telling me horizontal trend. You draw the trend line. Oh, this is telling me a downtrend. Okay, you draw the trend line, you know it. So for example, just now Tenaga, right? Okay, we look at Tenaga. So Tenaga is in a downtrend, this part here, okay? And then let's say we use the RSI. Okay, and then we call out another one, stochastic. Oh, okay, cross out one. So I'm looking at RSI and stochastic. Let me zoom in a little bit. Okay, so if we are looking at buying in dip, right? You buy whenever it is below that or touching or below that 20 or 30. RSI is 30, stochastic is 20. So there are a lot of trigger here. Okay, all these are below. So you buy. So you see that stochastic has more signals to buy. Okay, however, the RSI has less signal to buy. So that is why some people, they prefer to use RSI than stochastic, because otherwise you keep buying. You see, you keep buying. where do you have all this money to buy? You don't have much money. So therefore, RSI in a sense is better because it will give you the signal only when it is really oversold. Okay, so here you buy here, oversold, right? And then the next thing is here oversold. Do you see that here is higher, here is lower, but both are below that 30. Okay, you see here, here. Okay, here are oversold here, and here also oversold. But however, this price here is lower than this price because we are in a downtrend. How do we know we are in the downtrend? You draw a trend line. We're in a downtrend. Okay, so which means that when you draw a trend line, you see that we are in a downtrend. And then if you are trying to buy at the lowest point, you can use, but then you will have to be prepared that it may not be the lowest because the trend may be going lower. Okay. Okay, answer live, and then let's see if I have. Okay, RSI. Oh, so just now I already said on what situation RSI can be used, horizontal trend or an uptrend. The effect will be better. Okay, the effect. Okay, so what I'm just trying to use it effectively. Okay. Suitable setting of I can't see the word. I can't see the word too much. Okay, never mind. Okay, so then we are looking at the application of this stochastic. Okay, so we know that it has to be horizontal or uptrend. It will be better. So let me show you one uptrend chart, which is maybe Tesla, but it was last year's Tesla trend. Okay, and see whether sometimes it is so bullish that it may not touch that 30. Okay, so let's say we are looking at daily chart. Okay, so let's say we are looking at the, I want to move this one. Okay, so here, this part here, it was a very nice uptrend whereby you are just like bouncing off from that 200-day moving average. You are consistently above that 200-day moving average. Okay, so you are on the uptrend. So when you're on the uptrend, right? So you see that these are all buy opportunity. Okay, so all these are buy opportunity. But however, because you are so bullish, you may hardly hit that that 30% here because RSI is 30. So then you may use that stochastic. Okay, so occasionally I do use stochastic is when the technology stock, it is too bullish. And yet I wanted to buy this technology stock so much. So then how? And because the RSI is not telling me to buy, it is not touching that 30. So therefore I will use the stochastic and then I'll try to buy whenever it is below that 20. You get what I mean? So meaning that it depends on the chart. Okay, so if let's say it is a very, very bullish kind of a technology stock and you know the RSI can never touch that 30%, then you can use that stochastic because stochastic can give you more triggers, okay, than that RSI. Okay. Okay, time is running very fast. So this is the RSI formula whereby we are using 100 minus 100 divided by 1 plus RS, whereas our RS is the average gain of the past 14 days divided by the average loss of the past 14 days. Okay, because each day you have a gain means positive, loss means negative day. So if let's say you have a green bar, means that that day is a positive day, gain. And then gainers or losers. Okay, sometimes you see, oh, gainers and losers. Gainers means how many stock are actually having a positive day. Okay, so that is gainer. Losers mean how many stocks are having a negative days. So therefore, we are using the average gain of the past 14 days divided by the average loss of the past 14 days. Okay, so this is a formula. So then this is the RSI, whereby you have the scale here, 30 and a 70. So below 30 is oversold, buy, and then above that 70 is overbought, sell. Okay. Okay, principles of the momentum. So next we talk about sometimes you do see people mention, some of the YouTubers, they say, oh, we see that the price is having a divergence, a price and positive divergence, negative divergence. Okay, so what is this divergence? Okay, so here you are looking at this as the price. Okay, and then this is the indicator. Okay, it could be stochastic or RSI. Let's say RSI. So if let's say you are looking at the price is moving up and then the indicator is also moving up, is it bullish or bearish? Bullish or bearish? Bullish. Okay, so if it's up and up, bullish. Okay, good. If it's down and then this is down, bullish or bearish? Bear. Okay, good. How about when it is down and the momentum is up, bullish or bearish? When this share price keep dropping and dropping and dropping, whereas you see that the momentum is going higher, higher low and higher low. It's changing. Yes, you are you in. Okay, so are you says that it is changing, it is reversing. Okay, so when you see this, it is called the positive divergence. It is a bullish divergence. Very good. Okay. Yes, it is called the bullish divergence, which means the price is going to change and then you're going to see some upward momentum. Of course, you need to draw a price trend line here, because otherwise I have seen quite a number of times whereby it is supposed to have a positive divergence, but because the trend line haven't break out yet, and in the end it continued to fall. I've seen. Okay, it's not that it will not happen. Okay, so that you have to apply this trend line and then to see that it is having a trend line break. Then this one is called a negative divergence, whereby the price is going higher and higher, but you see that this RSI here is trending down. So then this is called a negative divergence. So we know that it is going to fall. The price is going to fall. Okay, and of course you must have this trend line break as well. Okay, always remember, indicators are indicators. You have to use the indicators together with the trend line. Okay. So the next principle is that the more divergence, the wider it is, it's more significant. So if you see that it is like so, the divergence is so huge, then the rebound is even stronger. Okay, and then this fall down will be even bigger fall. Okay, so the wider the divergence, right, the magnitude, right, then the impact, the price impact will be bigger. Okay, divergence must confirm by the price. Okay, through the trend line violations, price pattern, moving averages, and other indicators. So definitely you must have the trend line. Okay, and then you must also see if there's any chart patterns. Always remember, in any technical analysis, chart pattern will overrule many things. Okay, chart pattern is number one, then trend line, then all the indicators. Okay, because if you see a very obvious chart pattern, that chart pattern will overrule, will dominate the whole thing, the whole event. Okay, basically, especially if you see a very, very obvious kind of a chart pattern that everybody see it, because the market participants all looking at the same chart. So when everybody see it, right, the kind of action that they're going to take is all together and the impact will be dramatic. Okay. here, more wider, because sometimes you will see that the price going down, but it's like a small down, okay, small down, and then this momentum is like small up, so it is not so the magnitude is not so wide. Okay, so if let's say you see that the price fall is very sharp, and then the momentum is also picking up very fast, then you know that there will be going to be a sharp reversal. Okay, so this is looking at that wider divergence. You get me? So it has to be momentum, full of momentum. Okay. Do trend channels belong to trend lines or chart pattern? Trend channels is trend channels. Okay, so I would like to look at the channel as in like a zone, trading zone. Okay, the channel, the channel is like when you're moving up, right? Then you are looking at this channel. So this channel is more like a zone that you are trading around. Okay, and trend line is trend line, because trend line you are looking at trend line breaks. Okay, so which is different. How do we detect end of downtrend? Trend line breaks. Okay, let's say you see the trend line, okay, break. So it will be the first sign of ending of the trend line. And then if let's say you see a chart pattern form, head and shoulder, and then it break, finish, this trend is over. Okay, so sometimes you see that the trend line break, but then it still continue to go up. But sometimes after the trend line break, there is a big chart pattern forming, and then it break, finish, over. Okay. Any effect when global market trend is down? Any effect when global market trend is down? Your question is, are you looking at if there is a global financial crisis, will it affect the Bursa Malaysia stock? Is it? Yinmi, you're asking this. Of course, global financial crisis will affect all the financial market. If you look at 2008, when we had that global financial crisis, right? Not only the equity market crashed, the commodities, oil price also crashed. All financial bond market also crashed. All financial market is crashing. Okay, so that is global financial market. Okay, so it will affect all the market, including our Bursa Malaysia, Asian markets, European market, all. The chart patterns are more important than the trend channel? Yes, chart pattern is number one. Okay, chart pattern is more important. And okay, individual stock, okay, later. Okay, I make it cover my slide first. Then oscillators can also plot the trend lines and price patterns too. So for example, if you look at the RSI, okay, so here, right, I can plot trend line over here. I can plot trend line. Okay, I can plot the trend line like this. Okay, so there is a break. Okay, so then break. Okay, this one together with this. Here, you also see that trend line break. Okay, so here break, and then here break, buy. Okay, it go up. And if let's say down, you can also plot trend line here. Okay, make it like this. Trend line break. Okay, then you also plot a trend line here. Okay, then it will break down over here as well. Okay. Okay. Difficult to maneuver this chart. Okay, never mind. Quickly, I cover my slide first. Okay. So case study and finish. Okay, so we go back to the chart there. Okay. So here, let's go back here. Okay. So here we are looking at the RSI. Okay, I usually like to use RSI because stochastic, as you can see, too many oscillators, like too many of this oscillation. Okay, so I prefer to use RSI. It's easier to see. And then this one, I go like this. Okay, I go like this. Break, break, down. So I confirm my trend line together with the RSI trend line as well. So let's see what happened now. Anybody holding Tesla stock? Let's see. Okay, so do you see that? Yeah, let me cross out this stochastic. Okay. Okay, what do you see here? First, the 200-day moving average, is it above or below? Is it bearish or bullish at the moment? What do you think about this chart? Bearish, right? And do you see a chart pattern? Like a head and shoulder, double top, and all this? Do you see a chart pattern? Yes, it is a chart pattern. Is it broken already, the chart pattern? Yes. Wu Yin say yes, broken already. So is it a downtrend? Confirm? Confirm downtrend. Okay. So this is exactly what is happening now. So this is the neckline is broken. And then this is a downtrend. So we can't predict so much. We just have to follow the trend line. Okay. So if you were to ask me, oh, will it go up or go down? Okay, I can't guarantee all this question, but what I can do is that I will draw trend line for you. Okay, so this neckline broken already, and then I will draw a trend line for you. Okay, I will say that if it were to break below this line, which is 610, okay, so in the next few months, if you happen to see that it break below the 610, it will go down. Okay, yeah, you see a double bottom, right? You, of course, you can see double bottom, but then it can also reverse. Okay, so it can also break out, it can also reverse. So if you see that it break out from here, 760. Okay, so if you see that it break above that 760, then the chances of this to go higher is there. Okay, so the decision point is above 760 or below 610. Okay, then only there is something meaningful for you to trade. When it is still within this trend, it is still going sideways, and then there's no point for you to trade this one if let's say you are trading for it. Okay, yeah, sideways. So sideways, no point trading a sideways stock because it is sideways. Okay. Okay, so another one, let's say our front can. Okay, anybody holding front can? Okay, you see, if you were to ask me whether it will go up or down, no guarantee. What I can do, I will have to draw a trend line. Okay, I will draw a trend line. But first of all, is there a chart pattern? Yes or no? Is there a chart pattern? Yes. And then, is it broken already? Yes. Okay. So now, what you can do, you draw a supporting trend line here. So when it break below this 240, go down. If it break above this 266, it will go up. Okay, so you now can't do much. You just wait for that breakout. Yeah, actually it's a symmetrical triangle. It's actually 50-50. There's a 50% chance that it will go up. There's a 50% chance that it will go down. Okay, since it is almost 10, one last one, NIO. Okay, NIO is an electric vehicle whereby it's a Chinese electric vehicle. Okay, and it is a premium kind of a EV car compared to other Chinese EV. And the models are pretty nice. So people who like NIO, they will like the models, okay, the shape of it. And it's very future future kind of shape. Okay. Okay, so now if you look at the neo, right, the neckline definitely is broken. Okay, and this is my projection. So, and then I'm looking at this line. If it were to break below this line, then it will go down further. But however, there is a breakout over there. So therefore, there is a valid breakout. Okay, so it is a valid breakout. So now it just have to move and pass one resistance after another resistance. So there's no guarantee whether it can pass this resistance. So you just have to observe whether it can pass the green line here or it will reverse from the green line there. Okay, so it's either it will pass that green line or to reverse from there. So the minute you see that it is reversing from away from that green line, you have to sell. Okay, so let's say you buy here and then you are waiting for it to go higher, right? But unfortunately, it is reversing from that green line. Then you will have to sell it first. And then you wait for it to drop and then see how it moves. You get what I mean? So that means that whenever you observe the support and resistance, so if it reverse from that resistance point, you sell. Okay, if it passed that resistance point, continue to hold. Okay, and then after this resistance, the next resistance will be this neckline, which is 31, 32. So if it can pass again, continue to hold. Okay, if it reverse from there, then you sell. Okay, yeah, definitely overall it's a downtrend because you are still below that 200-day moving average. Remember, I told you if it's as long as you are below that 200-day moving average, you are still considered a long-term downtrend. Okay, so you are still a downtrend. Okay, yes. How about the key function of the Bollinger Band? Okay, this one is another indicator where I do not have the time to explain. So I will explain in the next session. Okay, Bollinger Band basically is the overbought and oversold. Look at the momentum. Okay, so it's overbought and oversold, the main thing. Okay, what's your favorite moving average crossover pair? Okay, I do not use crossover. I just use one only. Okay, so I do not have a favorite crossover pair. What's your okay, this
Yeah,
one
no more question on the panel already, Pauline.
Good.
Okay, thank you so much, Pauline, for doing the Q&A along with the session. So I think many of us here have learned how do we use technical indicators effectively. I think today, Pauline, you zoom in a few key indicators. I think many of them say that very enlightening. All right, thank you so much. Okay, so I hope that all of you here have learned, how to apply all these indicators that Pauline has just shown. So thank you so much, Pauline, for doing that.
Okay, thanks a lot.
All right, so if you haven't checked out Bursa Academy, you can scan this QR code and go to www.bursaacademy.bursamarketplace.com. It's an e-learning platform whereby it gives you a lot of information on resources and information about investing, be it in quizzes, articles, video recording, and so on. Our next Bursa webinar is happening on the next Monday, which is titled 了解三大财务报表，避开假账陷阱. All right, so that's in English, it means that avoiding financial frauds by understanding the three financial statements. All right, so on the next Monday, we'll discuss about that. So if you want to learn, okay, today our session is on technical analysis. So next Monday, we're going to look into fundamental analysis by understanding the key three financial statements so we can avoid the financial frauds. So like the title suggests, the session is going to be conducted in Mandarin. So it's happening on 27th of June, 8:30 to 10 o'clock. The registration link is here. Okay. So any subtitle? Unfortunately, no subtitle. But of course, we can arrange similar session and wait for it in other languages. Okay. We will have, we regularly do, session in BM and also in English. So of course, we have the most number of English webinars lah. Okay, followed by BM. The third is Mandarin. All right. So the next Monday is going to in Mandarin. All right. So yeah. Of course, if you want to improve your Mandarin, you can also come to the session, okay? But unfortunately, no subtitle. Okay. All right. Thank you so much to Pauline Yong, who is Director of Sigma Wealth, Sdn, who shared with us about how to apply technical indicators effectively. So I hope all of you here have learned a great deal about technical indicators. So do I. So may you all have a great rest of the weekend. So have a great weekend. All right. So bye, everybody.